Welcome everybody to our audited results for the year ending March 2025. Next slide is the standard disclaimer, which we will click through and come through now to the highlights, the executive summary. So what ECO provides the report on is that we have a robust business. We have had continuing strong performance, particularly in our gross margin and therefore our EBITDA. We had strong performance in the markets of China and North America, particularly. And so from an operating business, we had good revenue from two key regions, particularly in the second half. And then across the world, we had improving gross margins due to very good cost control and input costs decreasing. On our development side of the business, our R&D portfolio continued to mature. We reached a significant milestone of submitting to the European authorities our first vaccine, ECO Vaccine MS, a vaccine for Mycoplasma synoviae, which will strengthen our position in the Mycoplasma franchise and be our first entry into the preventative market, which is one of the fastest growing segments in animal health. Behind our near-term, late-stage portfolio, which has near-term value, we've got multiple modes of actions and multiple projects in development, which will underpin the long-term growth of the business. And in our near-term portfolio, mentioned as the ECO Vaccines regulatory, the ones in regulatory submission, we have a very high probability of success because we have reached this very late stage. So the probability of success for our ECO Vaccine MS and MG is in the 90%. And as I say, behind that, we have a broader product development of significant value coming along behind that. Next slide, please, Hannah.
Thank you very much, Hannah. Chris Wilks, CFO. I'll take us through the financial highlights and then we'll move into a deeper dive into the finances. So the headline, of course, it was announced at the interim stage during a trading update that we'd be showing a decline in revenue year on year, which came through exactly as guided at 79.6 million, 11% down year on year. The reasons for that we'll come to shortly, but they were very much signaled at the interim stage. The next click shows, Hannah, please. Thank you. That despite that reduction in headline revenue, there was some particular performance highlights. China showed a much stronger second half and seeing growth coming through there in China, with revenues representing just shy of 30% of the total for the group. Anybody who studied ECO will remember that in times past, China has represented as much as 50% in one particular period of the total sales. So dependency on China has reduced down to less than 30%. Next click, please, Hannah. Also, North America has been strong. David mentioned this earlier on. It's now not far short of China's representation of the total, being 20% of the total group revenue, and was 16% stronger this year. And that was despite FX headwinds. If you do it on a constant currency basis, you see that North America's revenue was plus 18% year on year, a very strong performance. That principally was in the USA. Canada is a very mature market, so that growth really came through from the USA market. Next click, please, Hannah. We did also signal at the interim stage that our Southeast Asia segment was trading badly, and this was down to a loss of a major client in Thailand, a company called Thai Foods, and unfortunately that did impact the full year result for South and Southeast Asia. That said, we have seen a return to revenue with that client. We've won that client back, and we've also added to the Southeast Asia segment with other key client wins. So post year end, that Southeast Asia segment is doing extremely well, supported by a solid order book, which gives us revenues for the full year where we want it to be more or less in line with the 2024 result. Actually, I should also say that post year end, we've seen that performance in China carry on through the first quarter, as we have in North America. The growth path that North America is on continued into the first quarter as well. So you put all those together, and we're looking forward to a half-year result which will be strong compared to last year. And the final click on this slide is we had a new generic enter the market in Brazil to compete with Avlison. As we navigated it well, and actually we've seen improved performance in Brazil as we've changed a certain element of our business model there, going more direct to market, not through distribution. So improving margins, improving volumes. Next slide, please, Hannah. Other financial highlights, gross margins have already been mentioned. We'll see more of that, but plus 3% year on year. EBITDA reporting exactly in line with consensus, and that was what was guided at the half-year point. And that has resulted in a small improvement in EBITDA margin and earnings per share plus 61%. Now, that's slightly flattered by some exceptional items. We sold our horse paste business, our equine business, early in the financial period. That was announced to the market. And we also sold some old licenses we had in Southern Africa, both of which went through exceptional income. So that obviously benefited earnings per share. The underlying earnings per share, a bit over the consensus there, so a bit under 2p per share. So still a good performance year on year. Net cash was strongly up from 22.4 last year to 25 million this year, and an improvement of the percentage held outside of China, 40% outside China, last year 36%. Again, reducing our dependency on China. Our new product development expenditure, 8.6 million, pretty much as planned, pretty much as budget, and we'll see more of that as we go on as to how our portfolio has progressed. Now, I mentioned earlier on the exceptional items that came through in earnings per share. We signaled when we announced the sale of the horse paste business that we'd be using some of those funds received to institute a share buyback. We've launched that in the last week or two. You'll have probably seen the RNS announcement on that. And that we're looking to a general meeting during August to gain shareholder approval for that share buyback, which is up to 2.5% of the shares in issue. And at today's share price, around about £1 million is the authority we're seeking to gain. Next slide, please, Hannah.
So just giving a summary of Eco in short order here, we have a strong core business. Our flagship product, Avlison, has great longevity and sticky revenue and indeed improving margins. There is a global need to control disease in animals, and this is where Avlison fits in. And it's used globally, and that helps to manage our individual market ups and downs that one finds from time to time. Avlison has a clinical edge. It's a modern low-dose macrolide, and it shows clear clinical benefits over older macrolides. And against generics, there are high barriers to entry, complex molecule to manufacture, and complex sale to make. And we are expert in both of those capabilities. And an additional ability has been we've been able to execute against is that some of the large cap peers that we compete against have largely abandoned the anti-infective space from an active position, and that leaves us a greater ability to compete against the market and provide growth. And that is one of the reasons behind the growth in the USA. Next slide, please. So as well as a strong existing business, we've got a clear strategic focus to be in the poultry and swine markets. Why? Because they are two of the growing segments in animal health, growing species, and we are entering in those species the preventative segment, and it's the preventative vaccine segment that is growing the fastest. It's one of the fastest growing segments within the overall animal health market. So great species to be in and a great sector to be in terms of prevention. Next slide, please. So our pipeline assets in R&D consist of a number of things. They consist of our late-stage mycoplasma portfolio. They also consist of multiple mode of actions. There's another six or seven projects in development following on the first wave of innovation. That first wave, as I mentioned, has about 90% probability of success. And then our follow-on innovation has got some very substantial innovation in it, and therefore some significantly high-value assets in that pipeline. Next slide, please. Those innovations that we have address some clear need in the marketplace. There's some very, very significant diseases such as PRRS, PRRS in pigs, and necrotic enteritis in poultry, where there are control mechanisms in the market, but they are not perfect, and there's plenty of room for improvement. So our entry via monoclonal approaches for these two diseases provides a great and a large significant opportunity ahead of us. Next slide, please. And if you add our portfolio together on a risk-adjusted basis, we've developed that portfolio along so that its net present risk-adjusted value is well ahead of 180 million sterling. So clearly a significant risk-adjusted growth potential in our portfolio. And next slide, please.
And so we'll go into the financial highlights, starting with our revenue segmental analysis. And the largest segment is China and Japan. I mentioned earlier that we saw 3% growth in the second half in China specifically. And that's pleasing to see because clearly that signals a return to growth rather than the declines we've seen in prior periods. And as I say, that has carried through into the start of this current financial year we see ourselves in. Strong growth in North America, again, mentioned that earlier on, continuing into this financial period. South and Southeast Asia, we talked about the loss of Thai food, but then the recovery. And we believe that with the order book we've got on hand, that supports revenues for South and Southeast Asia in line with the dark green bar there, the period ending March 24. So a recovery from the decrease that we saw in this last year. In Latin America, the label we applied to this chart, which is distributor prior year excess stock, relates to Mexico, where Mexico entered the period with excess stock in the pipeline, in the distributor pipeline, should I say. And so that hampered the revenue performance in this period. That is working through. It's not fully through yet, but we hope to see that return to normality during the course of this current financial year we're in. Elsewhere within Latin America, so Brazil, I mentioned earlier on, performing very strongly, and the other Latin American countries, such as Chile, Argentina, doing very well in those countries. Europe's slightly off, nothing to be too concerned about there. We have changed some of our distributors within Europe to reinvigorate that market, or those markets, shall I say, and expecting that to really come back this year with strength. Moving on to the next slide, please, Hannah. Gross margins. I mentioned this earlier on about the strong improvement we had this year. Clearly, 3 percentage points up year on year, and more or less in line with March 23. Each year, there are various components to the gross margin bridge, FX being one of them. And here we see that in each of these two periods, there's been an FX headwind in relation to revenue. But if we see an FX headwind on revenue, we see a tailwind on cost of sales because we buy our active ingredient for avicin in US dollars. And so that offsets the effect of revenue. And you see that coming through in each of these two periods. Now, the largest component of this improvement that we've seen has been 2.9% on net cost of sales decrease, which is the improvement we've had from a reduction in input costs to the core ingredient in avicin. Very pleased to see that. That hasn't fully wound through in the results yet, and we're seeing post-year end an improvement upon even beyond the 45%, and we've seen that coming through in the first quarter of the current financial year, largely as a result of the inventory working its way through the system and the newly priced inventory coming through the system. Geographical mix effect has an effect, although not significant in this last period. Moving on to R&D, we see here that we spent 8.6 million in the last year in cash terms, roughly 50% of that in expense, the other 50% capitalized. Slightly more capitalized this year because our focus was around these late-stage poultry mycoplasma projects, and they are nearing the end of their development phase, and so weight of expenditure in that area. Moving to this current financial year, we see we're guiding that the split of that expenditure, which will be fairly similar to this year we've reported, but more of it will be weighted towards expensed rather than capitalized, for the reason that we will have come to an end on the capitalized projects and we'll be spending more on the next wave of programs, which we'll talk about in a second. They are not yet in the capitalization phase, hence more of it will be expensed. To talk about administrative expenses, these are overheads. The reduction you see year on year here is an automatic reduction. Everybody within the business, employed in the business, gets a bonus, and a large component of that bonus is geared towards the financial performance of the group, so revenue and profitability. Clearly, we missed our budget this year, and so that financial component fell away. It does mean that people are then will be earning a bonus on their personal performance, which should pay out. But in terms of the overall performance of the group, you see that there was a reduction year on year solely associated with that bonus reduction. Moving to EBITDA bridge. So how do we move from one year to the next? Clearly, 7.3 million of EBITDA this year compares favorably with the year before last. And the reduction this year compared to last year was principally down to reduction in revenue, as we talked about earlier. But the reduction was not as severe as you might imagine because of the improvement in gross margin, because of the savings in admin. And so that is how we bridged across from last year's profitability to this year's profitability. So turning to the balance sheet, the largest numbers on the balance sheet are intangible assets, which is the capitalized costs of the R&D program, which we spoke about earlier on, and then working capital. And in working capital, you can see the impressive performance here. Inventories in absolute terms have more than halved in the 4 years on the page here, from over 30 million to less than 15 million. And trade receivables has also improved year on year between the March 25 year-end spot and the March 24 year-end position. We've presented here the debtor days and stock days as we have previously. It's a fairly crude calculation. Anybody can do this calculation. It's based on the annual revenues. And so, of course, it ignores the seasonality to the trading that you see within Eco. But nevertheless, it's indicative of good working capital management and good improvement year on year, which has driven the improvement in the cash balances, which is presented on the graph bottom right. So talking of cash balances, moving to the next slide. This is a new slide, and we've bridged here between the cash balances in each of the last 3 year ends. And we've bridged across for the cash balances, excluding the 51% owned subsidiary in China. Over the last several years, when we've presented our results, there has appeared to have been confusion around China. How much of it do we own? How does cash get repatriated, and so forth? So these next few slides are attempting to decouple China and present it in a simplified format. So starting with cash, the 14 million pounds of cash balance here is stripping out cash that's within that 51% subsidiary. And how you bridge across is obviously there's profit generation outside of China. There's working capital movements, which we've just looked at, and that's benefited the cash balances year on year. It's a relatively light group in terms of capital expenditure. So investing activities is a small number. And then, of course, if we're excluding China, then really what the rest of the group sees is a receipt of a dividend from China. So that's the other component that's expressed on the slide. 2.5 million pounds of dividend receipt in the year ended March 24, 0.7 million pounds in this last year. Why was it that much less in this last year? Because it was associated with the year in which the China business rebuilt its factory, in fact, built a new factory. That capital expenditure in China was a shade under 2 million pounds. Hence, not surprisingly, the China dividend was smaller in this last financial year. And which year does that actually relate to? So that 0.7 million pounds was received in June of 2024, related to the profitability in December of 2023. That was the year in which we rebuilt the factory. The dividend for this year that we have just passed through was received last month, so during June, totaling 3.5 million pounds. So that's already received in the UK. And clearly, all of this cash generation goes to show how we're able to self-fund the R&D investment, which you see very clearly on the chart here. So we've got growing cash balances, and we're able to fund the R&D programs. Next slide, please. So carrying on this theme of the simplified analysis of the group. So reminding you that really what we've done here is we've taken the consolidated results, we've taken out the R&D lines from the consolidation. So the expenditure on R&D and the tax implications of the R&D, and then taken out the China business, which that China business performance and results have actually been disclosed every year. They're in the accounts, but they're in note 15. So really just putting this forward and showing what the business looks like, excluding those two pieces. So what you have is a revenue performance which is consistently above 50 million pounds, gross margins which are pretty consistent in the 40s and growing, EBITDA which is nicely around 10 million pounds, again consistent. If you click again, please, Hannah, then we also see that we're receiving a dividend, and for each of the last 5 years, including the one we've just received, you see the range of dividend receipt is between £2 and £3 million. The only year in which it wasn't was the year we built the factory. And they're growing non-China cash position, funding the R&D program as we go through. So really, this slide, I think, goes some way to simplifying the way that the group can be viewed, which is a business which consistently provides a strong profitability around £10 million, receives in addition to that a dividend from China, £2 to £3 million, and has got growing cash reserves and is able to fully fund its own R&D program. And I'll let you contrast that with the market capitalization of the group or the enterprise value of the group and consider whether it's fairly valued. So moving past this slide to the next, I also wanted to have a look and see how efficient the group is, again, considering that core business, and just plotted the various efficiency ratios here. Very consistent story of improving efficiency ratios, which are above the weighted average cost of capital, which shows that shareholder funds are being properly deployed. The reason for the dip in March 24 was that reduction in dividend that we talked about earlier on. So it's arithmetical rather than anything else. But I think you can see here that there's good use of shareholders' funds as we manage the group. Now moving along, please, Hannah.
So let's have a look at our R&D growth engine. What we have here is our late-stage portfolio in the gold hexagons. That is the peak value. So you see Ecovaccine MS, larger peak value, which we expect that peak revenue to come 3 to 5 years after initial launch into the market. It's a greater revenue for Ecovaccine MS because this is a lightly competitive market. There is only one vaccine on the market in parts of Europe, no commercially approved vaccines on the market in the US. So we will be first into that market. The smaller blue hexagon is the R&D investment that we expect to spend before launch and to complete the regulatory pathway for all markets. So Ecovaccine MS provides a bigger opportunity than MG. The gold hexagon for MG is broadly 10 million sterling. It's smaller because MG is a more competitive arena with multiple competitors and a tougher pricing environment. Hence, it's a smaller peak revenue that we're predicting. The hexagon for long-acting florfenicol and anti-infective is smaller still, and that's because we've only factored Europe there. There are other regions in the world that we can take that molecule, but we've just factored Europe for the time being. We can take that into Asia, including China, but that number is just Europe. Then in the green hexagons that we see the second next wave of innovation with some substantial assets attacking some of these really big segments in the animal health environment, PRRS, necrotic enteritis, and PCV2 MHP, which is a bivalent vaccine attacking or preventing those diseases from harming pigs, and a very substantial market, quite a competitive market, so not quite as large as PRRS, that vaccine market, but with the PRRS monoclonal and the necrotic enteritis monoclonal showing substantive value and high degree of innovation. And again, the blue hexagon is the R&D effort to go, so what still needs to be completed. So higher value because they are mid-stage developments. Next slide, please. This next slide provides one more click, please. This next slide shows the peak revenue by product and the expected regulatory calendar rollout there. So we see with Ecovaccine MS for the EU, we've submitted and we expect approval within a year from now. The USDA, the regulatory authority for the US, following approximately 2 quarters after that. So the bulk of the world receiving approval for Ecovaccine MS within 1 to 1.5 years from now. and then other geographies can roll out as a consequence of that. So that's EcoVaccine MS. The next click will reveal the EcoVaccine MG rollout, which is hot on the heels of the MS, with MG expected in the following calendar year, so 2027. And this sets a pattern of our expected regulatory timelines and approval timelines, coming with a regular annual drumbeat of submission and approval from 2026 into 2027, and then 28 and 29, the next stage coming along. So next click, please. Also shows that with the long-acting fluorphenicol molecule coming through into Europe, expected some point in 2027. So we really begin to see the R&D pipeline delivering and carrying on. So I just wanted to give a little bit of a highlight onto why we're doing this and what we expect out of our EcoVaccine MS and MG. Well, we expect these to be a significant improvement from the existing MG vaccines and entering the relatively new MS segment. So we'll have a best-in-class treatment in Hallas that we already have, and we will augment that with best-in-class mycoplasma vaccines. So what that does is it allows us to address both the treatment side of the equation and the prevention side of the equation. So we're already experts and highly knowledgeable in this area, with good contacts with key opinion leaders and the key decision makers in these accounts. And we can add on to that with continuing technical support, continuing diagnostics, and continuing commercial support to augment our existing position in Hallas with our future position with EcoVaccine MS and MG. And that will help to support the product uptake. And we'll do this on the back of our existing distribution channels and our existing route to markets, but we also expect to extend those routes to market with new and stronger partners to help with these new product launches. Next slide, please. And the next, and this brings us to the investment case. And on the one side, we have the core business, where we've got our flagship product with, as we have evidenced, great longevity, increasing margins, and pretty sticky revenue. There's a global need for our products. We have clear differentiation and clear advantage, and we've got some room to operate and to grow against competition, which may be less dedicated to this market than we are. That's the core business, the existing business. And then you turn to the right side of this, which shows that we've got targeted investments in the growing areas of the product, of the animal health segments where we want to participate, swine and poultry preventative areas mainly. And we have multiple products in our pipeline. The first wave is just about upon us, with probability of success into the high 90s. And that's evidenced by the fact that we've got to regulatory submission with the first of those. So we've got a solid core business and an exciting and growing future business. Next slide, please. And bringing that together on the final slide that we have. So we have our commercial business that is generating great revenues and profits. We're able to divert that profit into growing our future portfolio. So we will have a transition story from our existing organic business, which is profitable and robust, to diversify our portfolio into more products and geographies, and with a pipeline that delivers on a risk-adjusted basis over 180 million. And that has grown substantially over the last 18 months. And that's grown largely because we've been able to mature and develop that pipeline to further elements and to further along. And that further along allows us to have a higher degree of confidence and therefore a greater probability of success. So with our focus on areas of unmet need, some niche and some bigger areas in our vaccine portfolio, we've got multiple shots on goal. We've got a pipeline that has a mix of assets, late and medium stage. They are maturing very rapidly, launching into substantial markets in the EU and North America within 12 and 18 months, respectively. And our balance sheet strength remains strong and provides us with some optionality, one of which Chris mentioned, which is reinvesting some of our one-time gains from the sale of our assets into a share buyback scheme that we hope to launch following suitable permissions gained at the general meeting next month, and that will provide anti-dilution effects for any shares that we release for long-term incentives and share options. And so we will utilize our balance sheet and our receipts from one-off revenues partially into that share buyback to help support our strategic aims. And with that, I will leave it there for the formal presentation, Hannah, and we are open to answer any questions that may have been submitted.
And we have a large number, so let's get going. Well, I think we've covered some of them in the presentation, but perhaps to reiterate, could we have an update on the expected timing of the launch of EcoVaccine MS?
We expect 12 months from now, end of 2Q 2026 into 3Q 2026. So we're about 1 year away.
Has there been any material changes to the peak year revenue and development costs of the pipeline?
Not since we did our R&D day in March 2025. And since March 2025, where we exposed that, there's been no changes to the revenues, but there has been progression. We have received from the EMEA the standard list of questions that they want answered before full approval. And we're glad to say that although there's a good number of those questions, none of them are fundamentally over-exercising, and we expect to be able to answer those before the end of September this year, and therefore the regulatory progress looks smooth to that launch timeline and approval timeline of about 12 months from now.
Okay, building on that, can you talk about the launch strategy for EcoVaccine MS? To what extent can you use existing infrastructure, and do you need to work with other key opinion leaders, and how easy is the manufacturing scale up?
We can use our existing infrastructure very largely, so our own technical resource and our own commercial and sales resource. We will use, to a majority extent, our existing distribution partners, but we will add to those. We will add distribution partners that have strength in poultry and strength in vaccines. So some we will roll over that we're existing partners, and some we will add. On the last question, the manufacturing scale up, we've completed our 2 of the 3 batches that we expect to do. First 2 are completely done. Third one is part the way through, and everything is looking smooth on that front for the final consistency batch.
Okay, I'm sure we'll come back to the EcoVaccine MS, but for now, Avlacin. When asked by someone unfamiliar to Eco why revenue is so much lower than in FY 2021, how do you respond?
Well, 2021 is a little while ago.
2021 was an exceptional year.
2021 was a one-off year where we saw some one-off effects from African swine fever that decimated the Chinese sow herd. And then we saw a big swing back as the population was rebuilt, and there was lots of disease as a consequence of that rapid expansion, and therefore lots of disease and a great deal of Avlacin usage. If you take that 1 year out, one exceptional 2021, we've seen steady growth around that. Not every year, but if you do the compound growth, there's been decent growth from the last 5-6 years, taking that one exceptional year out. We did see a detraction in revenue this year for the reasons that we've said, but that was mainly single region impact, which has largely been reversed. And we saw much better performance, as we've disclosed, in the second half of our financial year ending March 25. And that improved performance in both China, Southeast Asia, and continuing performance in North America has continued on in the April to June period post the year-end results.
Okay. Are competitors also increasing prices in North America in response to tariffs, and how do you compare?
Pretty much the same. So yes, and very, very similar amounts.
Okay, thank you. What happened to EBITDA in Latin America?
EBITDA in Latin America. Well, one thing that we improved was taking a more direct route to market in Brazil, which is the largest market in Latin America. So we saw improved margins in Brazil and therefore improved EBITDA. We tend not to report EBITDA region by region because regions don't hold the global costs such as R&D. But if we did strip it out, Brazil would have seen an improved margin and EBITDA. Mexico not quite so good because we had some excess inventory in the channel in Mexico. But aside from Mexico, Latin America saw improved margins as in Brazil, and therefore the EBITDA carried on improving in that way.
Perhaps another way to attack it is, what is the risk of generics coming into other markets, and is Brazil a one-off?
We have generics in a good number of markets, so we're adept at competing against generics. So there's generics in much of Latin America, with Brazil essentially the whole of Latin America. We have generics in a lot of Asian markets, including China and South and Southeast Asia. So it's not a one-off. We expect competition, and we've got a good track record of demonstrating ability to compete against generics on a number of different ways. One is that sometimes the quality is not as good, and also the way that we go to market with technical support and with commercial support is also can be a big differentiation for us against generics and other competition.
Okay, going back to the US, is the strength there down to adding new clients, or is it growth from existing clients?
A bit of both, but growth from existing clients would be the majority. There's several different drivers there. One is we're beating the competition. Two is the strength of the team. And three is the utilization of Hallas in elimination programs. We're trying to take out mycoplasma infection particularly from the sow herd. So increasing the treatment in the sow herd to clean the sow herd, therefore less transmission from the sows into the growing piglets, where most of these customers make their money, i.e. growing and selling piglets. So you get a better, healthier piglet, grows better, and is more profitable for the producer.
And can you say anything on the price versus volume split, again, with the focus on the US?
So we increased post-year end prices to largely to compensate for the small amounts of, or relatively small amount of tariff impact. So volume has grown in line with pricing. So it's not just volume growth, we're also getting value growth out of that market.
Okay, thank you. When do you envisage repatriating Chinese cash? What are the restrictions to exporting it?
So we dividend up to the practical maximum. So there are three components of our thinking when it comes to dividends out of the 51% subsidiary. Firstly, the profitability in the relevant year. I mentioned earlier on that we review the calendar year performance. So the dividend we received last month was related to the profitability in the year ended December 24. So that's the first component we look at. The second consideration is the distributable earnings or distributable reserves within that business. That's the legal maximum that you can distribute. And the third component is what's the cash flow for the upcoming year. We don't want to be in a position where that business is running short of cash to fund its working capital. So we look at the working capital requirements of that business and ensure that we don't exceed that. And taking all those into account, we then declare the dividend up to the practical limit.
Okay, and perhaps the optimistic follow-up. If you had 25 million of liquidity in the UK, would you pay a dividend?
Well, we don't have 25 million liquidity in the UK, so it's an academic question. That said, yes, that would exceed our requirements for the R&D program. So yes, indeed, we would look at that. And you know, we mentioned earlier on the share buyback program. That's arisen because we've had the success of cash coming out of these disposal events that we've had. So where we have these disposal events, these kind of one-off events, it's absolutely right to use some of that capital to, in this case, buy back some shares from the market to support future share vesting. Dividend is another form of distribution of capital, and that will be looked at in due course as our performance and the returns come through from the investment program, from the vaccine program.
And perhaps another option, as one investor suggests here, with R&D costs looking modest against this increasing cash balance, would you consider a one-off shareholder return such as a tender offer?
Nothing's ever ruled out, and we'll consider everything with the good guidance from our advisors.
Super, thank you. Can you talk about respecting NDAs you have in place, etc., the ability to add these development partners to your pipeline, and what discussions you have in progress?
So a number of potential partners came to us, knocked on our door as a result of some of the public disclosures we've made at events like this and at our R&D Day. And we have spoken to a good number of those, and we have continuing discussions and negotiations with a number of partners. And that would be around either a distribution partnership for the forthcoming launches, and there's a number that are active there, and also for our follow-on wave of innovation, our medium stage pipeline, where there's bigger potential assets. Also, we have discussions with a number of partners there on the idea that with some of these very substantial opportunities, a bigger partner with greater commercial heft and global footprint might allow us to have faster penetration and a faster route to peak sales in various markets. So they are those discussions, negotiations are continuing.
And I guess putting it another way, you must be frustrated by the market's lack of recognition in your share price. Do you see an opportunity to do a development partner deal earlier than perhaps you might have considered in order to prove value to the market and provide some impetus?
Well, I think that would be valuable, and many of the investment community would potentially reward us with that. We don't absolutely need a development partner, but I think it would provide suitable credibility. It might provide endorsement. It might also provide for the investment community a bit of reassurance. So those are other reasons that we are considering partnership. That said, it's got to be the right financially viable amount for on the table for our for whatever deal we are considering. So we're not going to undervalue our pipeline just to get a partner on board just for show. We want either the right partner and at the right price to be the right partner.
Okay, thanks. Are there any other non-core assets to go?
Nothing of great substance. We do have some still peripheral assets in various parts of the world, but they're relatively modest, I would say. So I wouldn't see it. While there'll be a considerable regular cadence of new launches, there will not be a regular cadence of these tactical disposals we've done over the last 12 or 18 months or so.
Okay, thanks. Just looping back to tariffs then, because I've got about 3 or 4 questions here, trying to build them into one. Can you just cover off the ways in which you can mitigate them? And then also talk about manufacturing, both in terms of your competitors and yourselves, and how that can be utilised.
So main area of mitigation for tariffs that we've employed and can employ is by price. There's also margin, because we've reduced our input costs, that's helped to support our margins. So it's tangentially related to tariffs, but the answer to the simple question is the main mitigation route for tariffs has been by price to the market. The question on manufacturing was, can you just run that by me again, please?
Just where do you manufacture and where do your competitors manufacture, and whether that can be another lever that you have to pull?
So we manufacture the source ingredient via a partner in China, and then we can finish the product into final product in a number of parts of the world. So in Canada, in the UK, and in the US. So there is some mitigation that we can do by moving production for the US into the US, but the starting ingredients we cannot make in the US, and most of our competitors also make their API, their active ingredient, outside the US. The vast majority are sourcing product from China, just like we are.
Okay, thank you. And then gross margin, one for you, Chris. You've implied further improvement into the next year. What can we expect going forward in terms of a number, and will that be sustainable in the long term?
Yes, yes, and yes. So improvement since year end. We reported 45% at year end. The first quarter has shown an improvement beyond that, which is going up into the high 40s. We're guiding folk to believe that our gross margins for this financial year we're now in to March 26 should be up in the high 40s%. Sustainability of that, well, there's a number of inputs to that. There's the question of what the competition is showing is doing. So generics coming into the market. There's a question of tariffs, and there's a question of mix. So putting all that into the hopper, I think we feel confident about the year end March 26 margins holding up, and the year end March 27. Beyond that, we will be ex-patent in all territories, and so it's a question of how we compete. Do we continue to compete with generics in the way that we've done to date, and manage to defend our position strongly? We work very much with our input cost partners, in particular the API manufacturer in China, to ensure that we maintain volumes and ensure that our cost of goods is appropriate.
Okay, thank you. And then trying to wrap up a few questions again on generics and patents. Which markets do you have effective and enforceable patents which keep generics out? What is the key to maintaining market share in markets where the generics do creep in? And perhaps, which markets are you expecting to see this in?
So a couple of comments just to parameterize that a little bit. Typically in animal health, you do not see the patent cliff that you see in human health, where you see very rapid penetration of generics and a significant decrease in price. Typically in animal health, and that's what we have experienced in Eco, is that there is long post-patent life and significantly less deterioration in gross margin, even in the face of generics, than you typically see in human health. So in China, for example, where we've had competition, direct competition for well over 8 years, we're achieving margins in excess of 50%. So just to show that we try to show that we have longevity in Avlacin, longevity post-patent, and the margins are pretty sticky. We have existing patents that are enforceable in North America and Europe, but most of the world where we don't have that, we've been able to execute continued revenue growth and decent margins into the 40s.
Super. Okay, thank you. In the RNS this morning, you mentioned disease incidence as a headwind. Could you expand on this point, please?
Well, disease incidence can be a headwind when it's low and can be a following wind when it's higher, because with avocin being used to help manage disease outbreaks and manage the impact of disease, where it's hard, where the disease is seasonally lower, for example, in the summer months or in certain years, that can be a headwind. As we're experiencing it right now, we've seen increased usage of our products on the back of people wanting either to control disease or wanting to control disease better with our products. So that's where the disease incidence can be a headwind or a tailwind, depending on the level. In the year that we're reporting, certainly the first half of the year it was lower and therefore was a headwind. In the second half of the year to March, over winter, there was higher levels of disease and higher performance from the company, and that has continued post-March, at least to the end of till the end of June.
Okay, thank you. With the right partner, do you think you can extract higher peak revenue numbers than are currently stated?
Potentially, yes. Our peak revenue that we've put out and we showed here are using assumptions about our own routes to market and our own distribution network. So there's potential for those to be faster time to peak, or even a higher peak.
And what are these assumptions behind these figures?
We base our peak values on a mixture of expected pricing, which is based on where the market currently is for existing products, or the cost of disease where there isn't such a good parameter of an existing product, such as MS in the US. There is no competition, so we look at the cost of disease, and then we look at so the price of the product in the market, and then the expected penetration and share of the market that we can get.
Okay, and then finally, just on Thai foods, where does the relationship sit today?
They are repurchasing. They've decided to rebuy with us. So it was a temporary hiatus. They're not quite back to the same levels as before, but they are a current client of ours. And as Chris mentioned, we've added new clients in that same geographical region of Thailand and indeed across Southeast Asia. So that deterioration in revenue that we reported this year ending March 25 looks to be much better in this year. And in fact, with the order book that we have in hand for that region, we will be executing in this year double-digit growth over where we were last year.
Super. Well, I think we've just about covered off all the questions in the hour. So thank you to you both. Thank you to our audience for joining us and for their many interesting questions. And we look forward to an update in another 6 months.
Thank you very much.
Very good, Hannah. Thank you very much.